I would like to welcome everyone to our Q4 top picks presentation and discussion. Please feel encouraged to ask questions of the team after they present. Now, before we get started, I would like to formally announce to everyone on the call and make an introduction to Stefan Quenneville, who has joined as of Monday. He will be covering the healthcare sector for us. We are very excited to have Stefan join our team. He brings with him a great wealth of experience and a really, really positive approach to his coverage. So he brings that buy-side investor perspective to everything he does, and worked as an analyst on the space with both Macquarie and Desjardins in Canada. He also has actual in-the-field experience, having worked with bioscience and at the World Bank.
I worked for CI for the last 4 years when I moved back to Toronto. And I worked for Morningstar. I was in Chicago for about 5 years, where I worked for Morningstar. And I worked in parallel at Abundant Venture Capital as an advisor. So I wasn't a full-time employee there, but I worked on a couple of private things as an advisor to the fund as well. And I continued that for a while. So, and then prior to that, I worked on the buy side with Stanton Investment Management in Montreal, and then did the sell side stuff we talked about with Orion and Desjardins when I started out. Just so people don't think I'm 7 years old. And I just wanted to say hi to everybody and say that I'm really glad to be joining the team, and I look forward to some money making in my PA with your top ideas. I've been watching these for a while, and some of them have done pretty well recently. So keep up the good work.
Very good. So glad you're on, Stefan, and formally welcome. So please feel free to reach out to Stefan and introduce yourself, and he will be there to work along with you. Before getting into the names, we would like to showcase our ongoing outperformance. As you can see, the Q3 returns at 15.6% outpaced both the TSX and the TSX Small Cap gains of 4.7 and 6.6% respectively. For the first 3 quarters, we are now ahead 24% against the TSX and the TSX Small Cap at declines of 3 and 8%. This performance just further distances our long-term performance vis-a-vis both indices. Now, as you know, our portfolio represents a collection of high beta, catalyst-driven names where we expect volatility and we expect a wide range of returns. Well, Q3 pushed the range of returns to an extreme. And fortunately, we had a 152% return for WELL Health, and Andrews, Air, and GTI came in with 67% and 27% returns, making the overall portfolio numbers so compelling. Now, if we can look ahead to Q4, we have 4 new names in the portfolio, those being Osino, Converge, CloudMD, and MDF within the portfolio. Once again, the whole portfolio construct is catalyst-driven, high beta names, where we will expect a significant range in the outcomes over the ensuing quarter. So we thought that Amr and I would lead off, as Amr has another presentation he is giving at 1, so he will be jumping off after he is done discussing his names. But now, in terms of leading in, I thought I would start off with our view on the IT services space. Our mantra, our approach here is pretty simple. It's follow the money. And there we look at the strong performance of the tech giants, be it Microsoft, Amazon, Cisco, and Dell. They're ahead 40% for the year to date. That in absolute or economic dollar terms represents 1.1 billion. That 1.1 trillion, reflects the surge in online traffic and the accelerating shift to an online economy. We see this as a reflection of the growth potential for IT services companies, where there is increased demand for cloud onboarding, and that onboarding is becoming increasingly sophisticated. which we read as higher margins. We also follow the money trail when it comes to private equity, where their interest in this space sees the same growth and the same margin profile, and their interest in this space is expected to lead to attractive exits on some of our names. Now, this sort of leads us into our first name, specifically Converge Technology, where we have we would call it a baseline price target of $330. We view it as a relatively straightforward investment. Since October of 2017, management has delivered on 14 accretive acquisitions, none of which have been in a competitive situation. And in the process, they've built up a $1 billion revenue run rate company. So management has clearly demonstrated its ability to source, close, and integrate deals. Now, they've done so with a widely communicated formula, which we describe as copy, paste, accrete, and repeat as a plan for the company. In a typical deal, they would acquire a $100 million revenue company with a crappy 3% margin. It's typically a straight value-added reseller, which is a nice term for an equipment reseller, to be tough on them. They will pay 5 times EBITDA, or in this case, it would be 15 million. That would be 9 million upfront and 6 million in earnouts. Now, the earnouts themselves are self-funded. And with the scale of Converge, they go into the company, they extend the payables from 45 to 60 to 70 days. They free up 3 million. With the scale of their buying power, they realize a 1.5% boost to those margins. And then in year 2, they look for a further 2% boost to the margins as they move it onto their platform and realize efficiencies of the platform, and as they change the payout structure for the sales force. So the sales force, because of the cross-selling of IT services, is seeing a lot more revenue generation and making a lot more money with a lower payout structure. It's a simple formula. They've applied it 14 times and it's worked. The stock itself has moved ahead significantly, but we still see it as undervalued at less than 5 times EV to EBITDA, where frankly, a takeover would likely see a valuation of 10 times EBITDA. A 10 times EBITDA multiple would be roughly $6.50 per share. So for us, it's a simple story and a proven management in a strong space. So very, very compelled by this name. And I think we will move along to our second name, similar thesis, bullish on IT services. Now with Quizzitive, there are 2 different arms to it. The first one being the IT services that represents, say, 50 cents a share at a 7.5 times EBITDA multiple. The second being the high growth ledger pay platform, we value it at roughly $1. That's based on 8 times revenues, where a double-digit valuation would be easily defendable in the marketplace. The difference with Quizzitive and Converge is that Quizzitive is wholly aligned and in many cases integrated with Microsoft. So Quizzitive offers the Microsoft suite of services on the IT services side. Microsoft sources targets and sends them to Quizzitive. Quizzitive then acquires. On the ledger pay side, they're coming out with an end-to-end platform for retailers that will facilitate quicker, cheaper, and data-rich transactions at the point of sale. This has been a bottleneck and an expensive pain for many retailers. Well, here you have Quizzitive working together with Microsoft in accelerating the product delivery to the marketplace. It's to the point where they have Microsoft engineers working side by side with Quizzitive engineers to get the full service suite out faster. The other partnership here is with dunnhumby, which isn't typically a household name, but in the retail space, they are the global leader in terms of extracting data from transactions and then monetizing that data. With the LedgerPay platform, it's partnered up with dunnhumby, and they're doing elephant hunting here. So you could see a deal announced as 5 million. You could see a deal announced as 15 million to the company. And just to give an unnamed example, the number 15 grocer in the US, if they were to adopt the platform, would represent over a 15 million annual revenue run rate to the company. So in this way, Quizzitive really lines up with our catalyst-rich portfolio doctrine. We look for announcements from the company in terms of getting a bank sponsorship and moving ahead as LedgerPay. And probably over the next 6 months, we will see some very significant wins coming out of the dunnhumby partnership. So 2 IT services names, a little bit of a different complexion to both of them. We see both as being very attractive for investors. Cool. On the next one, we'll just do a bit of an intro here on the telehealth space. We do have CloudMD in the portfolio, but we are restricted on the name, so we can't speak directly to the name. The only thing that we wanted to convey here would be our view that this is truly the beginning of the story, that this is a very sustainable momentum in the marketplace. And why we see that. We see all parties as being aligned. The government, they want cheaper, better care, and they have a huge sensitivity to rural coverage. 19% of the population lives in rural areas. Only 9% of physicians live in those areas. So telehealth or virtual care extends the coverage out to the 19% of Canadians in rural areas who probably have 25% of the vote. So the government is aligned. Physicians in Canada, roughly 40% of physicians work full-time. So working virtually accommodates their lifestyle preferences or flexibility demands. It's also one where we ask CloudMD about their physicians. Each physician who is currently on their platform is making more money and experiencing much greater flexibility. So physicians are aligned. Patients, we're all avoiding physical interaction. They are aligned. After the first experience, they also value the convenience and the quality of the care. Fortunately, all of this has happened at a time where technology is a clear enabler of much improved service capabilities. In terms of the market itself, just doing a back of the envelope type of analysis on that, the Canadian clinic market is roughly 40 billion. That's net 12 billion after physician payouts that are typically 70%. If you say that between a third and a half could go virtual, that's a $2 to $6 billion marketplace. But that's really only the start of the total addressable marketplace. As we see mental health being particularly applicable to virtual care, we see rehab, physio, etc. So the marketplace itself within Canada is significantly bigger. And then you look at some of the Canadian operators we have in CloudMD, in Well, in Think Research, and in CP2 Insights. They all have strategies and inroads into the US marketplace. The question of valuations, always a art versus science. Current valuations are like 10 to 15 times revenue. I think those valuations reflect both the growth of the marketplace, but also the expectation that these operators will be buying clinics at 1.5 times revenue, in that there's a sustainable supply of clinics coming to the marketplace at that type of valuations. And we see a sustained supply of those clinics because of a few things that have the traditional clinic model being redefined. Historically, clinics were 4 to 6 physicians with 5% margins, given the 70% payout ratios. Those are now becoming 10. So you get 10 physicians per clinic, where you integrate virtual and physical. So you're getting much more efficiencies on the real estate investment and efficiencies in booking. This is with the integrated model. With the introduction of additional services, there is the expectation that those 5% margins will move towards and exceed 20%. So when you look at the crazy revenue multiples, just recognize that that ARB will see a compression with every acquisition at 1.5 times revenue being valuation accretive. Okay. Now we will do the skip over CloudMD, and then our last name within the portfolio would be drone delivery. It's, I guess you would say, unfortunate, but in each of the names that we have in the portfolio, they've been a benefactor of this unfortunate pandemic, where drone delivery has seen regulatory agendas moved up in terms of approving drones and approving flights. So with drone delivery, we see it as a catalyst-driven name, and some of those catalysts that are on our pipeline would include 2 drones being approved within the current quarter. We expect to hear announcements of further commercial route wins, and we see the potential for further additional partnerships to be announced over the next 6 months. But this is clearly a very early stage company in what could be and should be a very large segment, a large vertical, building on the efficiencies and the reach of drone deliveries. And we are very convinced that the drone platform itself is competitive on a world scale. So catalyst driven, we look for significant announcements over the next 3 and 6 months. If there are any questions, I can take those now or offline afterwards as well. So I'm very pleased to hand it over to Amer.
Good afternoon. Thanks for joining us. I've got 2 topics today, MDF Commerce and Photon Control. Let me start by saying, if you're looking for cheaper revenue multiples than Rob's last couple of names, look no further. Let me start with MDF Commerce. We're currently research restricted on the name, so I'll have to keep it factual. Ticker's MDF on the TSX. A lot of you know this has long been one of the strong conviction ideas we've had. We took the management team, like marketing physically pre-COVID and virtually post-COVID, throughout our branches. And the big picture summary here is simple. The company went from a steady Eddie operation with anemic growth to one delivering very healthy growth rates under a new management team. And this is value creation 101. A dramatic shift in growth warrants a dramatic multiple re-rating. So we've long argued, actually, that it didn't take much to take MDF to healthy growth levels, and the performance of their underlying core assets historically were actually great, and they were only masked by one underperforming segment, which dragged everything down. And when you remove that underperforming segment from the equation, growth becomes very healthy. And this is exactly what is happening. And you see it on that slide where you see that consumer segment, which was the problematic segment. It went from 30% of sales 3 years ago to today less than 4% of sales. And suddenly we're starting to see the healthy growth rates. The second leg of growth is actually driven by fundamentals as opposed to the aesthetics that I just described. COVID is actually helping drive record sales for the company's e-commerce business. So you see it on that chart there, it's 30% of their business as at last quarter. So you can think of MDF's platforms in e-commerce like a Shopify or a BigCommerce, which recently IPO'd in the US. Only their clients are larger. So they deal with guys like Sobeys, like IGA, like DSQDC, which is the Quebec Cannabis retailer, Carrefour in Europe. And obviously with everybody ordering online and more retailers desperate to have a digital storefront, MDF sales are booming, both from existing clients and future clients that they're signing up. So that's the short factual summary on MDF. Again, we're research restricted, So I'll invite you to go read our last notes and on the research portal for more color on our thoughts and our thesis. With that, I'll move on to photon control. We're confirming it as a top pick. This is the third or fourth quarter running. Ticker is PHO on the TSX. There is a good 70% upside from here. They've had a fantastic Q2. Unfortunately, Q3, the stock is down 20%, and we think the recent weakness is an opportunity. Let me start with the big picture again. So the stock is the poster child of what we think of when we're looking at what a quality stock is. They've got decent and expanding margins, clean balance sheets, no debt, growing cash position, high free cash flow, then best-in-class ROE metrics despite being under-levered. Then just as a refresher for those who don't know the story, Photon manufactures temperature sensors that are used in the production of microchips. So it's a play on the semiconductor space. And when you think about the long-term drivers there is the proliferation of AI, cloud computing, IoT, the deployment of 5G networks. So all these trends are driving record growth for chips. It's no longer an industry that's driven by PC demand or flash memory for your smartphones, which was historically boom bust. It's still cyclical, but there are secular trends here. And when you think about these chips, they're getting smaller and much more complex in nature. So we're trying to increase processing speeds by reducing the circuit size. And that's where Photon comes in. So the temperature sensors that Photon manufactures are engineered into the equipment that produce the microchip. So this small little Canadian company directly has an impact on the yield of players like Intel, Samsung, Taiwan Semiconductor, which manufactures the Apple chips. So if these guys like overheat or overcool a chip in the manufacturing process, like all these big guys are scrapping a great deal of inventory. So it's a mission critical product. So that's the quick and dirty on Photon and what they do. So I just mentioned that the shares sold off recently post the quarter, and they also sold off with a lot of press on the US imposing an export ban on US players selling to Chinese chip manufacturers. We've expressed that in our notes. Our view is Photon is agnostic as to who's winning the market share war between the chip manufacturers. You could think of them as an arms dealer supplying everybody. So if you've got Taiwan Semiconductor gaining market share from the Chinese guys or Samsung doing that, it's really neutral to Photon. In terms of valuation, continues to be extremely cheap. It trades at 10 times PE for a company growing earnings in the teens with healthy margins. That's a steal, we think. And for reference, comparables are trading at between 14 and 16 times earnings. With that, I'm happy to take questions and take a breather as a pause.
So hello, I'm here to introduce two cannabis top picks for this quarter. They are the same two top picks we had last quarter, so sticking with our top guns here. We are sticking with Air Strategies and Green Thumb Industries. So I'd like to start off with Air Strategies. First of all, it's a mid-cap US cannabis company that operates in the states of Nevada and Massachusetts with leading market shares in both those markets. Both markets are approved for adult use sales, and the company has strong retail and wholesale presence and is vertically integrated. So Air was a strong contributor to our Q2 top picks portfolio. The stock returned 67%, well ahead of all of its peers. One of the best performing cannabis stocks globally. Certainly even though we had supportive equity markets in Q2, it outperformed most of the benchmarks you could comp it to. We believe one of the biggest factors behind this outperformance was the fact that the company delivered on our somewhat non-consensus call for M&A. We believe the company would be able to utilize the free cash flows it's generating to be able to conduct a sizable M&A transaction before the end of the year. But in fact, the company actually announced 3 M&A transactions and a lot larger deal size at that, and a lot more accretive on a multiple basis than we had hoped for. So all very positive, and the stock reacted favorably. However, although we've seen a good move in the shares, we don't think the full amount of the M&A and organic growth profile is currently baked into the stock. Looking ahead at Q4, we think M&A is going to continue to be the highlight. We expect one more major deal to be announced this quarter, and we look for the company to close on the previous 2 transactions it announced, where it plans to enter Pennsylvania and Ohio, which are some of the 2 most attractive US state markets in terms of cannabis. Both limited license markets where you're allowed to be vertically integrated, fast growing patient bases, and a large population and states that may consider a transition to adult use sales in the not too distant future. We believe the acquisitions AYR has announced to date were at a fraction of 1 times sales at maturity, and well below 4 times EBITDA for all the assets combined. So this would be very, very accretive for the stock, even though AYR itself trades at a low multiple. And that brings me to my third point: is the valuation here is very attractive on an absolute basis. You've got a lot of upside potential from a re-rating and very little risk. And we think there's little risk because the company is relatively under-levered, as well as having positive free cash flows today. So AYR currently trades, these numbers need some updating, but AYR trades at 5.6 times now. Our next year's EBITDA estimates, the peer groups in the low teens. So obviously the potential for significant upside re-rating. And I would just point out that multiple does not consider any M&A. That's just on an organic growth basis. So when we look ahead and we look at the potential that this company has to add to its earnings, to continue to build in a solid its presence in solid state markets, we think there's a lot of upside potential, both in the shares and in the financial performance. So when I look to Q4, our number 1 catalyst and the number 1 focus will be on M&A. That M&A will have to be financed, so we think a capital financing is coming. The company announced that it's looking at debt alternatives. We think that AYR is one of the most underwritable businesses in the US cannabis industry. It's one of the only generating positive free cash flow, and it's relatively under-levered currently with net debt of about 40 million as of Q2, and generating positive free cash flow. So that number is coming down. So we think the terms on that debt will be very favorable, and perhaps a pleasant surprise when it is announced. We expect that in the coming months, if not the coming weeks. And then finally, financial results. The 2 states that the company operates in happens to be some of the most impacted by regulatory actions taken after COVID-19. You will see impressive sequential growth coming out of the company's financial results when it reports Q3 results in November. And we think there's upside even to our relatively bullish forecast. So stay tuned for that in the coming weeks. I'd just like to move on to GTI now, Green Thumb Industries. This has been a top pick for us for a long time. This is the 5th quarter now that we've kept GTI in the top picks portfolio. It's a $3.5 billion US market cap US cannabis operator, one of the largest in the space, and we think it's a best-in-class business. This is a company that has outperformed our estimates consistently, both from a financial perspective and an operating perspective. So it's delivering projects on time. It's scaling. It's turning those key expansion, capacity expansion, and retail store expansions online in a timely manner, which is driving financial performance. It's a company we've had to take our estimates up several times already just this year. We also think it's going to be a top of mind company for the US federal elections. We have seen Vice President candidate Kamala Harris in the debate against Vice President Mike Pence. She committed to decriminalizing cannabis at the federal level, assuming her and Joe Biden are elected this November. We've seen a lot of interest in US cannabis stocks since then, and we expect to continue to see increased interest moving into the election over the coming weeks. We also believe that even if the Democratic Party does not win the House or the Senate or the presidency, we believe the status quo. There's plenty of opportunity for GTI to push ahead on organic growth initiatives. One such opportunity I would point out is New Jersey is headed to the polls in November, and on their ballots is a cannabis legalization question. So GTI is one of the 12 operators in that state. A population of 8 million people could see substantial benefit if that vote were to pass. Polls currently show 2/3 support in favor of that passing. So we look for that to offer upside opportunity as that medical state could potentially transition to adult use sales within the next couple of years. And GTI, as one of the limited license operators there, could be a market leader. And just finally, we think the industry data points that have come out recently are very positive. Out of Illinois, again, these numbers could be a little more current, but Q3 sales on a monthly basis have averaged 30% higher than Q2 sales in Illinois. That's on the industry level. So if we think of GTI as one of the larger and better capitalized players, one of the more one of the stronger players in that state, we think there's potential they could have an excellent quarter ahead, given Illinois is one of their largest states. We also look for continued rebounds in states that were impacted by COVID-19 in Nevada and Massachusetts, which are two significant markets for Green Thumb Industries. And we're seeing very, very early indications that sales in Pennsylvania and Ohio and other key states continue to trend very favorably. So we think there's a very strong quarter coming up, which should be announced in mid-November. So when we look at the Q4 catalysts ahead, top of mind company for the US federal, the US general election and state ballot initiatives, we're looking for strong financial results, and then potentially the company's in a very favorable spot, relatively underlevered, and on the cusp of generating positive free cash flow. They could begin to use their balance sheet a little bit more to expand M&A more aggressively. So I'll leave it there if there are any questions.
Thanks, Andrew. And then we will pass it over to Ryan. Cheers.
Hi, thanks for joining us today. We're introducing a new name, mining name for our top pick in Q4, Osino Resources. Osino's up over 100% year to date already, and 32% since we initiated coverage in June. We've got a spec buy 230 target. It's trading about $1.34 right now. So really the thesis is simple here. Osino rather just ticks all the boxes that we look for in a junior mining story: quality management, stable jurisdiction, scale and scalability, and share price catalysts and exit strategies. So we'll go through those one by one with a little bit more detail. So proven management, you really couldn't ask for a more solid team in the junior ranks than Osino. headed up by co-founders Haya Dawn and Alan Friedman. This is the same team that sold the nearby Otjikoto mine to a large producer back in 2011 for $180 million. And as a endorsement of their work there, that mine has really turned into a star performer for B2 since then. So with that experience, the team developed some exploration expertise in the area in Namibia where they are, which is a bit trickier than average given just some geologic cover conditions. So that's really paid dividends here with the kind of the second coming of Oryx Gold, and that's the company that owned the Otjikoto mine that they previously had. So they're using that again with the Twin Hills project that they have now. So that project is sandwiched between the Otjikoto mine that I just mentioned and the Navichab mine down to the south. So sandwiched between two producers on major geologic structures, so a nice neighborhood. And like I said, they have the expertise there now, and they've had their first discovery. And it looks like a sizable deposit is already emerging rather quickly. So nice location, solid team. The Navichab mine that I mentioned, there is expected to be a sales process there in the near future, as it's currently owned by a private equity group. So that'll bring more eyes to the region, whether B2 acts as a consolidator in the region or someone else, or perhaps Osino themselves. At least it will bring more eyes to the story and the region, which will only help. So the other thing we look for is catalysts for the share price and exit strategy. Well, we've got an absolute host of catalysts coming in the near term. Currently, the company has an 8-rig, about 45,000 meter drill program going on. And really out of that program, we've only seen 4 holes so far. So a lot of drilling to come by year end. And most of that drilling is going to resource definition. There will be some exploration, but that'll all lead to a maiden resource estimate in early 2021. And we're looking for anything in the neighborhood of 1.5 to 2 million ounces. Which will be a nice anchor deposit for this very large land package. They've got almost 7,000 kilometers in a kind of an emerging mining camp in Namibia. So based on an expectation of 2 million ounces, Osino is currently trading at around $60 per ounce on an EV per ounce basis, which is kind of at the lower, at the average of lower grade deposit comps. We'd argue that they should actually be trading at the higher end with given the attributes I've just mentioned, given the location, the exploration potential. This is the Twin Hills Central Zone where the resource will be defined is the first of more than a dozen targets just within that kind of deposit footprint area. So lots of work to go here. Scale and scalability. 2 million ounces on your first swing at the ball is a great start if that's what it comes out to be, and lots of land near mines to explore. So. And then all that works so that we get the resource in early Q1 of next year, and then a PEA that the resource will form the basis for in early Q2 of next year. So lots of catalysts to come, rapid fire, great team, great location. Namibia, I really don't think would deserve any Africa discount. Really, it's Africa light. It's Africa designed by the Germans. Rarely see any untoward headlines out of the country. Otjikoto has been running flawlessly since 2015. So just look for these catalysts to come out for the balance of the year and into early next year to propel Osino higher. As I mentioned, it's already up 100% year to date, 32% since we initiated coverage. So spec buy 230 target, and that is it on Osino.
Thank you, Brian. And very pleased to hand it over to Gabriel. Gabriel, over to you, please.
Thank you, Rob. The 3 key points that I'd like to make about Revival Gold in the context of our top picks portfolio are the following. Number 1 is in terms of catalysts, Revival is expected to publish the Bear Track Barnett Creek Heap Leach PEA this quarter. I believe we can expect a well thought out, well-designed study backed by solid consultants that lays a foundation for the company's future growth. Like the resource update in Q1 2020 that led to a strong share price appreciation, I believe that the PEA will also be an important catalyst for the story. Point number two is in terms of my price target, which I recently reduced to $1.45 from $1.80. The idea was to consider more conservative estimated PEA inputs and outcomes. My target is based on an EV per ounce basis, but is also anchored by heap leach scenario DCF. Number three is considering the foundation that I believe the PEA will provide for future growth. I'm looking for additional research growth opportunities through further exploration and drilling that are likelier to come after the PEA is published. So the PEA should be looked at as a gateway for further long-term growth that will also potentially open the door to a much larger production scenario based on milling of a large sulfide resource. I believe there is potential for further meaningful expansions to both heap leach oxide resources as well as mill resources at the Bear Track Garnet project. So in conclusion, the ongoing exploration and drill results and upcoming PEA will be the foundation for the company's future growth. And I think in combination with a supportive macroeconomic gold environment, Revival Gold will be well placed to deliver share price appreciation in Q4 2020. Thank you.
Thank you, Gabriel. And if anyone would like to jump in with them at this point, or we would encourage everyone to reach out directly to any of the team, either by email or by phone. So we thank you for your time. We thank you for your attention, and we look forward to continued strength in the final quarter.